For deep economic stories that impact your future, make sure you subscribe to Capital Explained. If you want to understand how money, markets, and power really work, subscribe to Capital Explained, the new banking reality in 2026. When access to your own money isn't guaranteed, picture this for a moment. You decide to send $2,000 to your grandson so he can cover his rent. It's a normal family transfer, something millions of people do every day. But instead of going through, your bank suddenly locks your account, not for a few hours, not overnight, for nearly 2 weeks. During that time, your Social Security payment can't be accessed, automatic bills fail, utilities shut off, prescription medications go unpurchased. And when you finally manage to speak with someone at the bank, they calmly explain that the restriction was placed to protect you. This situation sounds extreme, but across the United States in early 2026, thousands of Americans are experiencing exactly this. Banks now have expanded authority to freeze transactions whenever a payment appears suspicious. Not necessarily illegal, just unusual. In many cases, the decision isn't even made by a human being. It's made by software analyzing behavior patterns. And once the freeze happens, customers often discover something surprising. The bank may face little or no legal consequence for getting it wrong. Why this is happening now. At the beginning of 2026, many U.S. states implemented updated financial protection laws commonly known as safe harbor protections. These rules were designed to prevent financial exploitation, especially targeting scams against older adults. Fraud against seniors has grown into a multi-billion-dollar problem, and regulators wanted banks to intervene faster. Under these laws, if a bank believes there is a reasonable chance a customer could be a victim of fraud, it can delay or freeze transfers for days, sometimes up to 2 weeks, while an investigation takes place. Here's the key detail. Reasonable suspicion does not require proof. A flagged transaction, an unusual payment amount, or an unfamiliar recipient can be enough. And because banks are granted legal protection when acting under these rules, freezing first has become the safest decision for them. The rise of algorithmic banking. Modern banks are no longer monitoring only dollar amounts. Artificial intelligence systems now analyze behavior. They compare your current activity against years of past financial habits. Send money to someone new? That's unusual. Transfer more than you normally do? Another alert. Log in from a different device or location? Flagged again. Even how you interact with your phone or computer can matter. Long phone calls while accessing banking apps or hesitant typing patterns may resemble known scam behavior, triggering automated reviews. The system is designed to stop fraud, but it often stops legitimate transactions too. Helping family members, paying contractors, or making large purchases can suddenly look suspicious simply because it's outside your normal routine. When protection creates new problems, for people living paycheck to paycheck or relying on fixed income, temporary freezes can create serious consequences. A delayed account doesn't just pause spending, it disrupts entire financial systems built around automatic payments. Rent payments fail, late fees accumulate, essential services get interrupted. From the bank's perspective, preventing one potential fraud case outweighs temporary inconvenience. From the customer's perspective, access to their own money disappears exactly when they need it most. Another change few people noticed. At the same time, new financial policies introduced additional costs for certain types of money transfers. Beginning in 2026, some international transfers funded with cash or cash equivalent methods became subject to a small federal excise tax. While the percentage appears minor, it disproportionately affects workers who regularly send money abroad to support family members. Digital transfers connected directly to bank accounts often avoid the tax, creating a growing divide between fully digital banking users and those who still rely on cash-based systems. Increased financial reporting. There's also a broader shift toward tighter reporting requirements. Payment platforms used for freelance work, online selling, or side income now report lower transaction thresholds to tax authorities than in previous years. As financial institutions cross-check reported income with account activity, mismatches can trigger reviews or temporary restrictions under anti-money laundering and compliance rules. Again, investigation can begin based on patterns, not confirmed wrongdoing. Other unexpected freeze triggers. Account restrictions today can happen for reasons many people never consider. Joint accounts affected by another owner's debts. Long inactive savings accounts marked as dormant, large cash withdrawals requiring additional verification, government tax collection actions freezing balances temporarily. In some cases, individuals only learn about the issue after attempting to access their funds. The bigger shift taken together, these developments reveal a larger transformation in the financial system. Cash transactions are slowly declining, digital payments are increasing, and financial activity is being monitored more closely than ever before. Money in a bank account is still yours, but access to it increasingly depends on automated risk assessments, compliance checks, and institutional safeguards. Systems created to reduce fraud are also reshaping how financial control works in everyday life. Final thought, the modern banking system operates on security first, convenience second. For many people in 2026, the biggest surprise isn't fraud itself. It's discovering that access to their own money can temporarily disappear, not because they did something wrong, but because an algorithm decided something looked unusual. Educational content only. This discussion is meant to explain financial system changes and their potential real-world effects, not provide financial advice. Under updated anti-money laundering policies, banks across the United States have quietly adjusted how they monitor customer activity. Officially, federal rules still require cash transactions reporting at the $10,000 level, but internally, many banks now act long before transactions reach that amount. Why? Because financial institutions are trying to avoid responsibility if a transaction later turns out to involve fraud or money laundering. Instead of reacting after problems occur, banks are choosing to intervene earlier, sometimes much earlier. The result is a strange new reality. Customers increasingly find themselves explaining why they want to withdraw their own money. A bank employee may ask what the cash is for, who it will go to, and why the payment is necessary. If the explanation seems unclear or raises concern, the withdrawal can be delayed or even denied. From the bank's perspective, this is considered responsible risk management. For customers, however, options are limited. You can file a complaint. You can move your account elsewhere. But most banks operate under the same regulatory pressure, meaning similar policies exist almost everywhere in the industry. Fewer branches, less immediate access. Another challenge making the situation worse is the steady closure and transformation of bank branches. Many large financial institutions have converted traditional locations into advisory offices rather than full-service branches. These centers focus on loans and financial planning instead of handling large amounts of cash. In practical terms, this means walk-in withdrawals are becoming harder. If you need significant cash or a cashier's check, appointments may need to be scheduled days ahead of time. Emergencies don't always follow appointment calendars. Imagine facing a home repair crisis late on a Friday afternoon. The contractor requires immediate payment, but the nearest branch no longer handles cash transactions without prior booking. The only option available may be an ATM with a daily withdrawal limit far below what you actually need. Convenience, once the promise of digital banking, suddenly turns into delay. Device security lockouts. Security systems have also grown stricter in 2026. Banks now rely heavily on device recognition technology. If you attempt to access your account from an unfamiliar phone, computer, or location, while traveling or hospitalized, for example, automated defenses may immediately lock access. The system assumes potential hacking activity. To regain entry, verification codes are typically sent to your registered mobile phone. Without that device, account recovery becomes extremely difficult. Older backup methods, such as answering personal security questions, have largely been removed because they are considered vulnerable to cybercrime. No phone often means no access. Payment app restrictions. Peer-to-peer payment platforms are introducing their own safeguards. When sending money to someone new through services like instant transfer apps, banks may impose temporary limits on the first payment. Initial transfers might be capped at smaller amounts, while the remaining funds are delayed for 1 or 2 days. These cooling-off periods are meant to stop scam victims from rapidly sending large sums to fraudsters. But they also slow down legitimate emergency support between family members. Helping someone quickly is no longer always possible. A financial system driven by algorithms. What analysts increasingly observe is a financial environment shaped by automation and constant monitoring. Digital banking promised speed and simplicity, yet the modern experience often involves surveillance, verification checks, and transaction reviews. Nearly every payment is analyzed. Unusual behavior attracts scrutiny. Institutional protection has become the priority over customer convenience. Disproportionate impact on seniors. Older Americans are affected more than most. Because fraud prevention programs primarily target scams against seniors, automated systems treat large or unfamiliar transfers made by older customers as higher risk events. In practice, individuals over retirement age may find their financial decisions questioned more frequently. The intention is protection, but the experience can feel like needing permission to manage one's own finances. The economic divide. Interestingly, these restrictions do not affect everyone equally. High net worth clients often work directly with private bankers who understand their financial habits personally. Large or unusual transactions can be approved in advance through human communication rather than automated systems. Middle class and working class customers, however, rely mostly on algorithm-driven oversight. For households living paycheck to paycheck, even a temporary account restriction can create serious hardship. Those without backup credit lines or multiple accounts are the most vulnerable when access suddenly stops. Challenges facing immigrant communities. Immigrant families encounter additional complications. New transfer costs on certain international cash remittances increase expenses for workers supporting relatives abroad. At the same time, fraud monitoring systems frequently classify international payments as higher risk. Many recipients overseas are individuals rather than established financial institutions, which appears unusual to systems trained on domestic banking behavior. The outcome is predictable: more reviews, more delays, and more verification requests for completely legitimate transfers. Small businesses and reporting changes. Small business owners and gig workers are also adjusting to expanded reporting requirements. Payment platforms now issue tax forms once transactions connected to goods or services exceed relatively low thresholds. This does not create new taxes, but it ensures income reporting becomes more visible to tax authorities. The complication arises when personal transactions become mixed with business payments. Selling used household items online, for example, may still generate reporting documents even when no taxable profit exists. Without proper records showing original purchase prices, individuals may struggle to demonstrate that no taxable gain occurred. Record-keeping requirements are growing significantly, especially for people unfamiliar with tax documentation. How people are adapting. Financial professionals increasingly recommend practical adjustments, maintain consistent transaction habits whenever possible. Inform your bank ahead of unusually large transfers. Handle major transactions in person when available. Avoid unnecessary joint ownership on accounts. Regularly access dormant accounts to keep them active. Many advisors now also suggest keeping limited emergency cash reserves at home to bridge short disruptions caused by account reviews. For international transfers, digital payment methods connected directly to bank accounts often avoid additional transfer costs applied to cash-based services. Business owners are encouraged to separate personal and commercial finances clearly and maintain detailed documentation for every transaction. Preparation, rather than reaction, has become essential. The direction of modern finance. Taken together, these developments point toward a broader transformation. Financial systems are evolving into environments where transactions are continuously analyzed by automated intelligence. The reasons sound reasonable: preventing fraud, combating money laundering, and improving tax compliance. Yet the long-term question remains: as security increases, how much immediate financial freedom are customers willing to trade for protection? Because in 2026, the defining feature of modern banking may no longer be speed or access, but oversight. Over time, something important has changed in the modern banking system. Access to your own money is no longer completely guaranteed. Today, it often depends on automated systems, risk analysis, and institutional approval. Banks are increasingly relying on artificial intelligence to monitor financial behavior. Every transaction is analyzed, compared to past activity, and evaluated for potential risk. If something appears unusual, even if it's completely legitimate, the system can slow it down or temporarily stop it. You don't have to do anything wrong. The system only needs to believe that something might be wrong. Because banks now face heavy regulatory pressure and legal liability, they tend to act cautiously. That means more account reviews, more frozen transfers, and more delays affecting ordinary customers. For many people, everyday banking has quietly become more complicated. Some individuals respond by keeping more physical cash outside the banking system. Cash carries risks: theft, loss, or damage. But it provides one thing digital money sometimes cannot: immediate control. Digital money, on the other hand, ultimately remains under institutional authority. The situation people call an emergency isn't only about new transfer taxes or regulations. It's about moments when access to money suddenly disappears right when it's needed most. During emergencies, repairs, or urgent family support. This system didn't appear overnight. It developed through years of regulations aimed at preventing fraud, stopping money laundering, and improving tax enforcement. Each rule made sense individually, but together they created a financial environment built around monitoring rather than trust. Technology accelerated this shift. Modern banking AI studies not only transactions but behavior, devices used, login patterns, timing, and activity history. The goal is fraud prevention, but advanced monitoring also increases false alarms. Legitimate transactions can look identical to scams from an algorithm's perspective. Older customers often feel these changes more strongly because banking once worked differently. You could withdraw your money freely without explanation. Today, unusual activity may trigger questions or delays. Younger generations raised in a digital world often see constant monitoring as normal. Meanwhile, banks invest billions into compliance and surveillance systems, and those costs eventually reach customers through fees, lending rates, and reduced returns. The financial system is moving toward greater oversight, automation, and control. The intention is protection, but the result is a system where access to money can sometimes depend on approval rather than ownership. The real question moving forward is balance. How much security is necessary? How much financial freedom should remain? Because the biggest change may not be the taxes or temporary freezes themselves, but the gradual shift toward conditional access to your own money. And many people may not fully notice that change until they experience it personally.